I would second your comments about the importance of this research. We spend a lot of time and effort, not just in the United States, but around the world on bank supervision and bank supervisory efforts, and certainly a lot of economic resources are spent to that end. And I think the paper's at least initial validation that there are some positive impacts of that certainly are intuitive to me from having lived it on the banking side, but also I think, hopefully, will be beneficial for opening up avenues for additional research going forward. And certainly the methodologies here are good, and I think pave the way for, future work in this area. The perspective I'm bringing today is one of a community banker, although I may have to turn in my bank card after they find out I'm praising the efforts of bank supervisors and enforcement actions, because bankers traditionally take a dim view of those things. But our bank operates in Texas and Oklahoma. We're about $3.8 billion in assets. We have 40 locations, about 550 employees, and we are regulated by the Oklahoma State Banking Department and the Federal Reserve Bank of Kansas City. So that gives you a little context of where I'm coming from. Some additional context is, during the great financial crisis of 2008, I was a bank regulator, and in that process oversaw the examination function for a number of problem banks throughout the western part of the United States, and also signed a lot of severe enforcement actions against those institutions. So I have some perspective from that side of the table as well. Now with that, let's talk a little bit about the research. As we've heard, the basic premise of Andrea's paper is that bank inspections reduce distortions in the credit markets and result in positive spillovers to the local economy. And after reading the paper, I would observe that one of the distinctions it makes, which I want to reinforce, is the difference between regulation and supervision. Regulation is hardwired. It tends to be fairly inflexible. It's hard to change, whereas the supervisory process is much more fluid. It's tied to best practices. It can be adapted if there's an appetite on the part of the supervisor to the situation in a given bank, and you can make the punishment proportional to the crime. So we've seen the pendulum swing back and forth here in the United States between both approaches, and we currently have a balance between laws and regulations that govern the business and the supervisory flexibility to deal with problems that are identified in a tailored manner. And I tell people all the time at our bank that we have a senior partner in the bank in the form of our regulators. We can benefit from their perspective on how we're running the bank. We don't always agree with our regulators. We engage in robust discussions with them, but we can all benefit from the dialogue. There's a phrase in the Bible that says that iron sharpens iron, and we believe it's a good life strategy at our bank for sharpening up our processes through the regulatory conversation and hopefully avoiding getting ground to powder in the process. Andrea's paper's research was conducted on the Italian system, and we've talked a little bit about that already, and that's different from ours here in the United States in two broad areas. One is the subset of institutions that are inspected are done through a risk selection process. And second, those inspections are carried out on a surprise basis, which is kind of interesting. In the United States, every bank and every chartered bank in the United States is examined on a regular schedule, and those examinations usually occur after a great deal of coordination and collaboration between the bank and the supervisors. I like our system. I think it incentivizes us to foster a spirit of cooperation
also, at the CPRC are
with our regulators, and hopefully put in place sound policies and processes that will sustain the bank through the cycle. And in that case, I feel confident that, at least at our bank, we're confining the supervisory conversations to the margins of our operation rather than having our, getting in a situation where we're in trouble and then there's a surprise inspection and then a wholesale reassessment of the fundamentals of how we run the bank. All that said, it really doesn't surprise me to see that troubled banks that clear the regulatory risk screen, in this case in Italy, do clean up their acts following the examination process, in the sense that they correctly classify loans, they reassess banking relationships with unproductive companies, and they reallocate credit to the benefit of the surrounding community. In some respects, and Yoel kind of mentioned the drawbacks of that process and that methodology and drawing broad conclusions from it. But I do think Italy presents a really interesting observational laboratory for studying the impact of the supervisory process. And I think his team does a really good job of developing methodologies to analyze and quantify the impact. I think, we know there's fewer banks in Italy on a pro rata basis than perhaps we have in the United States. And that in and of itself may lead to the change in policy at any single institution having a greater impact on the local economy than you would see in other ways. And so in talking about the flow through to the local economy, which I thought was an interesting avenue that they went down, I would observe from my own regulatory experience that if you're targeting a troubled bank, surprise inspection or not, you'll find that asset quality problems are rarely divorced from the capital account. And as supervisors in the great financial crisis, for example, when we would prompt banks to charge off problem loans or replenish reserves, we usually found that we precipitated a capital crisis in short order. And this capital shortage would put constraints on growth. It would prompt management usually to shrink balance sheets in order to right-size our regulatory capital ratios. And there wasn't a lot of capacity in those situations to direct liquidity toward more productive economic enterprises, even if those could be found in the context of a broader economic recession. So that's just some feedback on that point that I would provide. And in the United States, we have the CAMELS situation where we're looking at each component individually, but I found that, at least in my experience in the crisis and my experience even here in the bank, those things are all interconnected. Your liquidity, your asset quality, your capital, and even management's oversight of the situation are all kind of working in tandem and, would sometimes inhibit your ability to assess the impact of either any one of those being detrimentally impacted. So, I think it's an interesting paper, and I think it sort of bears out that the supervisory process, whether it happens by surprise or whether it happens through coordination, can really have a good and beneficial impact on bank policy and bank practice. Now I'll turn to Remy's paper, which really looks at the impact of enforcement actions on bank lending, and it finds that it benefits lending to minority and women borrowers. Specifically, that following enforcement actions, banks significantly increase mortgage lending to minority borrowers and less likely to deny loans to minority borrowers, and the reasons for the denials change. And I found all of that very interesting. And I just a nuance in the U.S. system, and it may be this way around the world, I don't know. Most mortgage loans in the United States are sold by the originating entity within 30 to 60 days following origination. So not a lot of those, except in some of the larger banks, are actually put into the bank's portfolio for the long term. And this creates an incentive, I think, for banks to underwrite to the investor or underwrite to the secondary market rather than apply the full level of prudential underwriting that you would see on a normal portfolio commercial loan. And we all like to think we bring a high level of independence and discipline to the process, but the incentives being what they are, we feel like there's a focus sometimes on the secondary market appetite rather than the fundamentals of the credit. And the authors point out that a lot of this is distilled down into a reliance on these non-price factors: credit scores, debt-to-income ratios, collateral valuations. And in my view, that can lead to a paint-by-numbers mindset on the part of mortgage underwriters and can be discriminating against minorities and women. Even unintentionally, it can happen. And the reasons for that, as the authors point out, are that minority borrowers tend to suffer the most from denials under these guidelines because they have lower incomes and less wealth. It's not a surprise that when these disparities or issues are pointed out to banks by enforcement actions, the authors find they tend to reduce their reliance on non-price factors and expand their geographic reach to harvest more applicants from, and that results, has the effect of increasing lending to minorities. There are two interesting outcomes they found that I really want to focus in on. One is that despite the decreased reliance on non-price factors, they did not find an increased corresponding increase in non-performing loans or other evidence of credit stress. And I think that's interesting because I think a lot of banks retreat to the argument that if we go after the quote-unquote underserved borrower, that we're going to have to lower our credit standards, and it could imperil the safety and soundness of the bank. And I think their research, obviously a lot more work needs to be done in that area, but I think it was interesting that they found that the increase in minority lending did not necessarily lead to an increase in non-performing assets, which I thought was helpful. Second, they found that the mix of minority borrowers that the banks were allocating credit into were doing it through refinance activity as opposed to house purchases, which seemed to blunt the impact of increasing minority home ownership, which would be a societal good that we would want. And I would just point out that anybody who's refinanced a home loan knows there's benefits that can come from cashing out equity or lowering your loan payment, and the effect of increasing household disposable income, can be significant in a situation where the household disposable income is in the low to moderate end of the scale. So I just thought that was interesting. And the other finding, they studied a number of motivations for why banks did this and why they achieved the outcomes that the authors found, one being, reducing structural issues or internal constraints that prevented them from lending to minorities in the first place. The other is that mortgages have a lower risk weighting, thus can claim less capital than would traditional avenues of lending. But the one that I found compelling was that bankers were found to, quote unquote, cater to their regulators in the wake of a significant enforcement action. And that really resonated for me, because as a banker, you want the benefit of the doubt from your regulators. You want them to know you understand the message they're sending. You want them to reduce the intensity of the enforcement action, and you also want to reduce the duration that you're in the penalty box. So certainly a broad reassessment of how you're approaching things, particularly areas that might be in favor with the regulators, such as enhancing lending to minorities, might be at the top of mind for banks as they seek to win back the favor that they may have lost, as Yoel pointed out, in the long process it took to get to the enforcement action. I grew up on a farm in Florida. One of the things that I heard a lot from my elders was that there is very little education in the second kick of a mule. And I have not been through the process of a significant enforcement action on the part of as a banker, but I can imagine, having been through that experience, you don't want to go through it again, and you would be looking to ensure that that doesn't happen. So two suggestions for further research I would point out. One is I would look at the originate to sell model versus the portfolio model that the paper seems to focus on. And the question would be, do banks that undergo enforcement actions enhance their interactions with minorities and women across the product set, or is it just in the portfolio mortgage component? The incentives are different there, and the underwriting criteria is much more mechanical when you're selling the loan. Second, I would make the point that it's not only your subject banks that are impacted by enforcement actions. These documents are public. They're widely discussed in the banking community. They're featured in banking publications. And I think it prompts a broad reassessment on the part of other banks in the area when one bank gets in trouble. I mean, how many of us, when we drive along the highway and we come by the blinking lights of a traffic stop and see somebody getting a ticket, the first thing you do is you look at your own speedometer and make sure you're not breaking the law too. And I think, I've even had instances in my short time as a banker where, we've seen banks in our market, undergo scrutiny for one reason or another, and it prompts an internal discussion as to whether, there's areas there we need to be more proactive about in our situation. And the final observation I'll make, which really applies to both papers that we're looking at today, is that, the observer effect is real, and I think these papers both pointed out. And, I'm sure you all know the observer effect really sort of captures the notion that the simple act of looking at something changes its character. And coming under the regular and ongoing gaze of our regulators does have an impact on banks, whether it's through the general promptings of the ongoing supervisory process or whether it's the more dramatic thunderclaps of a significant enforcement actions. We do change our behavior because we interact with our supervisors, and hopefully that changes to the better, and hopefully we can avoid these second kicks of the mule. So with that, Yoel, maybe I'll stop and we can open it up for discussion.